All right, we're going to start today by looking at the S&P 500 like we usually do. Okay, so you can see in the past week, we went up about 5%. And if we're tracking this uptrend, we're at the top end of our trend line, and we're super overbought for the last month. So it seems like we're in this upward channel right now. The next stop is probably continuing to ride the top of this or at the bottom of this channel, most likely at the bottom of this channel. The key thing to watch in the S&P is the 200-day moving average, which is the green line. You can see that it's basically turning from a downtrend to flatline right now. It's going to be very important to watch to see as the stock market retreats in the coming week if it bounces off the 200-day. If it stays above the 200-day moving average, the green line here, that is really good for the stock market. We have a lot of momentum. We have a bad news story this morning about the U.S. debt being downgraded. As you can see, the in this article right here, it says investors wait another Monday jolt after Moody's downgrades U.S. So it looks like that's the catalyst for the market to go from an overbought state to an oversold state. And we've been hanging on this tariff promise for like a month now. Um, so you have to watch and make sure that these levels hold for the 200-day moving average and the bottom end of this trend line. You can see from all indications for every one of these, we're super overbought, more than we've probably ever been in the past couple of years. So this is not the time to be establishing new positions. It's and for the most part. We'll go over this a little bit later, the downgrade of the U.S. debt and what it means. And okay, let's look at some more of the stories on Yahoo Finance. Um, Here's a story from Yahoo Finance. A little too enthusiastic. Wall Street warns about chasing stock rally. So you can see we're super overbought. We have turned from extreme bearishness, extreme fear in the fear greed to greed. So you got to think kind of contrary. And right now we're overbought. So let's look at some of the meeting notes for today. Okay, we just wrapped up kind of a really good time in the stock market, better than probably any time in history in the past month. And we're going through a period of time right now. We're going to have one big earnings report from NVIDIA coming up 26th. Other than that, we basically have the month of June, which isn't typically good. Let's look at the month of June. It's typically up 0.02%, which isn't very good. So we're going from a very strong seasonal month in May to not a very good June. And then we have August, September, which are typically not very good months. So we're in an overbought state right now. It makes sense that we'll probably consolidate, in a coming time right now. So be ready for that. Don't get over your skis right now and start buying things Monday morning because it's about time for there to be a correction. All right, so let's look at some more of our talking points. Okay, we have a lot of momentum in the stock market right now. We have 54% of the stocks in the S&P 500 above the 200-day moving average. Okay, that's a good sign that there's momentum building. But everything that we were fearful about, in the last Emancipation Day, whatever they call that, um, no, it was April 8th, whenever the stock market went down. We still have those problems. We just kicked the can down 60 more days. So we still have a lot of uncertainty in the market. We have The 10-year going up. It's actually going to go up probably more in the coming week because the US debt was downgraded. So we have the 2-year is up also. So that's usually not good for the stock market. Rates going up means it's higher borrowing costs for companies. So let's look at some more of our talking points here. Okay. Okay, so we can see the S&P 500 chart. We're kind of in an uptrend right now. We basically erased all the lows for the year for the S&P 500, and we're above the 200-day moving average. So let's watch and see this week if we correct, and if so, um, we'll see if we have these levels of support, if they help any. Let's look at the S&P 500 when going back to the time of COVID. 5 years ago, we had support at these trend lines. Okay, so if we do, for whatever reason, go down and test these levels again, you'll know that we do have support at this 5-year level in the S&P 500. If you trace the lows and the highs of this chart, let's look at the 10-year yield. This is interesting. The stock market continues to go up while the 10-year yield goes up, which is um, it's indicating hmm, well, it usually does the opposite. So for the past year or so, you have as the yield goes down, well, it's a one-to-one correlation right now. As the 10-year goes up, the stock market goes up. Let's look at some of the variables in the stock market. The price of crude oil is $61 a barrel. That is the same as last week. It's a really low price of oil, so it's an indication that the economies around the world are slowing. Also, it's an indication we have more pumping of oil around the world. And if there's a deal with Iran for a nuclear deal, which is right top page headline stories every day, then the price of oil will go down because there'll be a lot of more supply on the market. Um, let's look at inflation is staying the same around 2.39%. The dollar index is unchanged, and gold is down 4%. We'll take a look at the chart of gold a little bit later on. The dollar index continues to be in a downward trend. And fear greed index, we're at greed. So our translation is take some profits off the table or don't buy. So we have a lot of people fear of missing out in the stock market. A lot of the retail traders are actually buying the dips. Um, so now we have a piece of news such as a US debt downgrade that could affect the stock market in the next week. Um, the AAII survey is bearish still. This is the most it's been bearish in a row since the time they started keeping track of this. So look at this for the past how long here? Since February 5th, there have been more bears than bulls. Okay, so the fear index VIX is down to 17. That is complacency. People are not afraid of the stock market going down. This will probably jump on Monday and Tuesday as the fears of the US debt crisis or materialize. So we'll see about that. But if the VIX gets up to 55 again, like it did during this Liberation Day, then it's a good time to start looking to buy. Because the news about the debt downgrade is already known around the world. We've already had 2 of the 3 rating agencies in the world downgraded the debt of the United States to that same level a long time ago, 2 years ago. So um, we'll just keep our eye on his VIX. Right now, there's a lot of complacency, but that could change very soon. We have a lot of greed in the market. So our emotional graph, we're basically out of the fear capitulation stage, and we're fear of missing out as of Friday of last week. We're probably going to start return to the normal or fear in the middle of next week if this um, debt crisis issue downgrade materializes in the stock market. Okay, so okay, let's look at some of the things we were worried about, things that could lead to a crash. Higher yields on the U.S. 10-year Treasury. Um, Interest rates rising will cause problems. So we have this debt downgrade. That could be a cause for the stock market to go down. Downgrade of U.S. debt. This is exactly what we were saying for a year now. Higher Treasury rates. We know that the United States government is spending more than it should, and it's unsustainable. We just had this debt downgrade, and we could have higher Treasury rates, and that could re-rate what people are willing to pay for stocks. So that just happened Friday after the close. So um, we're not sure. This is one of the factors that could cause the stock market to go down. So let's go to, and we have one more thing, NVIDIA earnings, and they're expected to be stellar. So if they're anything but stellar, if they mention they have some kind of write-offs or whatever, and the stock goes down, the stock market will most likely go down with it. But we're watching that. That could happen in the next week. Okay, so we have a PE ratio in the S&P of 24 now. That is far above the average. So we could correct like 30 or 35% in the stock market, and that will take us to a PE of 16. Um, so be ready for that if that ever happens. Um, Also, let's look at the first to worst. Okay, so we have healthcare has been in the news recently. Um, the presidential administration is talking about forcing drug companies to lower their prices, and that might not be even constitutional. They might need Congress to do that. So, but even the fear of the current administration forcing the drug companies to lower their prices, that is causing the whole sector to go out of favor right now. So that we could not predict that really, and that's what's happening right now. So and we'll look at a couple of those stocks in that sector a little bit later on. Okay, so we have um, almost every sector flatline to positive for the year, which is pretty amazing. The sectors doing the best are utilities and industrials. Um, and the ones doing the worst so far this year are healthcare and consumer discretionary. So let's continue to watch this. Um, okay, let's look at some of the stocks going up and down today. The We see United Health. We'll look at that a little bit later on. This is a stock that we saw in some of the top 10 holdings of mutual funds. It's super out of favor right now because they've had day after day of negative news headlines. And recently we've had some news of directors of the company buying back the stock, purchasing stock at these levels. So it's an example of a stock that's the number one stock in their sector, healthcare, and they they're way out of favor. They are currently trading at a multiple. Let's look at United Health just for fun because it is down over 50% this year, and it is held by some of the top. Let's look at United Health. Hmm. Okay, so let's look at the statistics. Okay, this gives us a little, okay, hold on. There's a saying in the stock market, catching a falling knife. This is an example of a stock where it's down 50, around 50% this year. It's a blue chip stock, but it has stories like there's accounting fraud and um, there are indications that they had bad earnings report. They had more costs for doing surgeries than expected. So that, in other words, their management isn't that great. So, okay, let's look at their stock right now, their stock chart. Their PEG ratio is 0.65 according to Yahoo Finance. Um, Profit margin is pretty low. It's 5%. That's probably not good enough. We need 10 or 13%. Return on equity is okay at 22. Um, but when you hear things like accounting irregularities, you can't buy it. It's really until that's resolved, until you know that their accounting is clean. So it's a very dangerous situation. It let's look at this chart. April 8th, April 8th, it was 588. Now it's almost half. Look at that. It's a fall from grace, basically. Super oversold. But with the news headlines for this company, it's almost impossible to buy. The people on TV on CNBC are like advocating this stock, um, but they've been advocating it all the way down. And every day it seems like there's another 14% down day. So it's sometimes you have to invest in quality stocks that are going to start. It's like buying a car that starts every day. You pay a little bit more for it, but it's worth it in the long run. So this is a good one to stay away from. Um, and also, they call this a dead cat bounce. Whenever it goes up, after it went down a lot. So a lot of the stocks in that sector are going up with it in sympathy, like Humana, um, healthcare stocks. Ele Elevance Health is another managed care provider. So this might be up for the day, but it's catching a falling knife is very dangerous, and you could very easily lose another 14% in the stock with another bad news story. So we're going to focus on other companies that are a little more predictable. Okay, so let's look at some of the sectors that are up today. Okay, healthcare. Um, that was kind of I think they're up because some of the healthcare companies are starting to move, like the United Health and Humana, et cetera. But that's super dangerous, and you can't really trust companies that have accounting probes. Okay, let's look at some more biotech. Okay, we have that theme. Um, let's look at the price at a 10-year just for fun. Okay, the 10-year has actually been going down recently. No, it has been going up. It's been going down. Okay, so as the price of the 10-year goes down, that should help Utilities, anything that yields has a high yield, such as biotech or healthcare has a high yield. Utilities has a high yield, and as the interest rates go down, the it's easier to buy a house because of lower interest rates. That's why housing is up. So, and gold is out of favor right now, but we'll look at the chart of gold. It seems like there could be a contrary. You can start looking at gold again. Let's look at that. Okay, so let's look at Dan Now's picks from the beginning of the year. Cisco is actually one of the best performers this year. It's up 7%, and it pays a dividend, and cash is doing pretty good too, 4%. And he actually deployed his cash during the downturn. So in the banking ETF is up 3%. So that was a pretty good pick so far. Um, Here's a news story. Um, this is on the front page of Yahoo Finance. A little too enthusiastic. Wall Street warns about chasing stocks rally. Okay, so right now we're super overbought by every facet that we're looking at. So you can see we're overbought here. We are overbought in RSI and the MACD. It's higher than we've been in multiple, like at least a year. And we're at the top of this trading range. So what they're saying in this article is it's very dangerous to buy right now. Don't get started. Don't start any new positions. I'm concerned about the magnitude of the rally we've seen, and the market might be a little bit too enthusiastic that the trade worries are behind us. Actually, we've only kicked the can down 90 days, down the road 90 days. So we still have a lot of uncertainty. And we still have this tariff issue. We have erosion of trust in the US, um, and that's gonna cause the stock market to people are not going to be willing to pay for the multiples of the stock market the way they used to. So the trust in the United States has severely been bruised. So all that said, this is a time to either not buy or wait. It's a time not to be getting into the market. It's a time to either sell or not buy. All right, so let's look at this very important news story that came out Friday. Moody's cuts America's pristine credit rating. Um, they reduced the US's credit rating to AA1. It used to be AAA, and the two other rating agencies downgraded the US debt 2 years ago or more. So the last time the US debt rating was cut, the stock market went down 10%. So you can see right here, August 1st, 2023, we had this period of time in over three months where the stock market went down 10%. So that's why there's an immediate negative um, on the stock market whenever the debt rating was cut. But it doesn't really mean that much because we've known for at least 2.5 years that the other two agencies downgraded it to AA1. So it's not really news, but it's on wire. Whenever the algorithms see this news story, they sell immediately. So be ready for a pullback in the stock market. Um, Here's an interesting article I saw from Investors Business Daily. Follow-through days provide clues to fresh market rallies. So if we look at the S&P 500, you can see that you had this huge crash right here. You had a follow-up day for 9%. Right about here, you see there were some follow-up days, and basically it's whenever you have a correction and then you have 1 or 2 days that are positive. And see this that 20-day extended move, the exponential moving average you can see whenever it started turning up, like right here, that was a good indication for it for, that the trend has turned and we're starting to go up again. So we're going to start looking at this 20-day extended exponential moving average anytime we're looking into buying a stock. Right now, most of the stocks we're following have an extended exponential moving average that's positive, but it's not like turning from going down to going up. So if you look at almost every one, it's super overextended right now. Okay, so that was a good news story here in this meeting notes. Okay, so and they're giving examples of individual stocks like Netflix, whenever it went down, and then it had 2 days of follow through after a downtrend. So I'm going to keep track of that. And next time we see this downtrend and the extended moving average start to go up with follow-up days, this is what Investors Business Daily kind of their method of determining trend changes. All right, let's look at some of these charts that are interesting. We see the price of gold has been going down. You can see we're in this upward channel. We're up, what, over 20% this year, but we're oversold. No one wants gold right now. And you can see it's at the bottom of its channel. And, if you're interested in gold, if you believe the story where central banks around the world are buying gold and diversifying away against the dollar, this is a good time to start looking at it. But if you're not, Warren Buffett would never buy gold. So um, see that Warren Buffett says that gold doesn't pay a dividend. It's kind of speculative, and it doesn't have earnings. So, anyways, I just thought it'd be interesting to note that as the stock market is going up, the fear of uncertainty um, goes down, and with that, the price of gold goes down. But it is oversold. Um, let's look at healthcare ETF. You can see that we're in a super downtrend, and we're getting bad news in this sector on a daily basis. Latest news was there's a counting probe with UNH we just talked about, United Healthcare, and now the current administration is talking about forcing the drug companies to lower their prices to match what they're charging in other countries. If that happens, of course, they're not going to be as profitable, and the threat of that is causing the sector to be super oversold. But you can see that they're kind of in the bottom of their downtrend. We don't see that extended moving average moving up yet, so it's not a good time to buy this sector yet. Look at this yellow line. This is still going down. Whenever we see it starting to move up and with 2 days of follow through, then that could be a time to start looking at this sector. Let's look at, okay. Okay, it's times like this we have to remember about quality stocks. These stocks have been held that I'm watching here in these mutual funds for over 10 years, and for the most part. So if we ever see these stocks go on sale, it's a good idea to start dollar costing into them if you don't have your accounting irregularities that you have to worry about. So let's look at some ones that are out of favor now that might be ones to start looking at buying. We talked about Eli Lilly last week. They're out of favor, but we don't know how far they're going to go down. We have Google's out of favor. We have other ones we can look at here. Okay, actually, Microsoft is one of the best performing of the Mag 7 this year. Why would it be doing well this year? They have momentum in the cloud for Azure. They're growing their revenue for that. They have a diverse portfolio of stock of offerings that they sell to businesses mostly. So business, so you're not dependent totally on the consumer. And they have a lot of cash, and they have one of the best credit ratings in the stock market. I think they still have AAA rating. So it's a very safe stock to hold for a long time. But right now it's overvalued. Let's look at our stock screen for this week. Some interesting things that showed up all of a sudden. We have United Health. Um, this is the one that has accounting irregularities. Um, according to Fidelity, their PEG ratio is 1.74. Um, and they're actually, forward EPS growth long term is 7%. That's not that great. Return on equity is 23. That's great. Um, it's in our watch list, but the news, until things clear up with their news stories, it's you can't touch it. So Eli Lilly is still, in our top list of stocks. Um, Here's an interesting one we haven't looked at for a while. It's American Express. You can see that their business model is to um, is credit cards. They actually take risk. When someone defaults, it's on them. They um, they have a higher they have a clientele that are higher end. For instance, they have the customers that are paid more, and they spend more. So they have a good combination, and they grow around 14% a year. We're going to look at them. American Express. You can see by the earnings estimates, they are expected to grow 14 to 15% a year for the next foreseeable future. And you can see that their forward PE is 19. So they're like a 1.4 PEG ratio according to our calculations. The profit margin is above our 13 that we're looking for, and the return on equity is 3 times what we're looking for. And they have zero debt. And so basically they're growing at 14%. If we look at their stock chart, you can see that they mirror the S&P 500. So even though they're growing at 14%, um, they're whenever the stock market goes down, it goes down like 1.2 times more than the S&P. And whenever the stock market goes up, they go up 1.2 times, what the S&P does. So you can see it's like an exaggerated version of the S&P. So, okay, so it's overextended right now. It's overbought along with the stock market. So it's probably not a good time to buy this one. But we're going to keep an eye on this whenever it gets to the point where it's oversold. In the times where it's been oversold, like right here, and right here, you can see it's a good time to buy. So this is an example of stock that Warren Buffett owns, and it's high quality. And it's in the sector that I like, which is fintech, credit card payments. Okay, American Express. Let's look at what CFRA says about it. They say the fair value it's undervalued by 6.29%. And their earnings are going up, which is great. Their average PE over time is about 14%. So their PE is right where it usually is. So let's look at what CFRA says in their little write-up. This is very important. Their 4-star buy, which is a very good rating, reflects their unique positioning to weather economic uncertainties through its high-end customer focus. These clients show resilience during the high inflation time of the 2022s. They maintaining a strong network volume growth. Their spend-centric model, with only 25% from net interest income, provides downside protection. The premium card market is expanding with top 10% of earners now driving 50% of spending versus 36% decades ago. So basically, they have a credit card that has lower delinquencies and higher spending, and they have a premium user, high-end user. So that's all really good. And they're not affected as much by the economy. So if there's issues with the economy and all stocks go down, like you see, next time we see this scenario for the stock market, we're going to keep our eye on American Express to see if we can pick this up if as the stock market's selling off based on whatever news story it is. I think this is a good quality buy and hold. Warren Buffett bought this in the 60s, and he still holds it, and it's one of his biggest positions. So whenever someone like Warren Buffett owns the stock, you know that you're in good company. Let's see what Morningstar says about it. They said the fair value is lower than where it's at now, so it's 30% overvalued. They have, according to them, they said they have strong results on better spending volume, and they report another quarter of mid-teens earnings share growth with core EPS 16%. So they're growing 14 to 16% on average, which is pretty good. But they think they're a little bit overvalued right now. Okay, so I thought that would be interesting. Let's look at what else do we have? Okay, that's all I had to say for today. I hope you enjoyed that. I hope you have a really good investing week. Um, and I'll talk to you all next time.